Good afternoon, everyone. Edward Talisse, Chelsea Global Advisors, and the CQF Institute. It's 13th of March, 2015. This week, we're going to talk about the developments in the global financial markets that we've seen occur in Japan, Europe, and in the United States. It's been an extremely interesting and somewhat volatile week, particularly here in the U.S. But before I jump into that, I think it's important that people note that the Nikkei index in Japan has finally broken above 19,000, which has been a level that we haven't seen in many, many years. So it seems like the combination of Abenomics and a much weaker yen has really started to grab hold in Japan, and Japanese equities are trading extremely well. Similar story in Europe, where the ECB's quantitative easing program, which began earlier this week, along with a significantly weaker euro, has continued to add some fuel to the stock markets in Europe, and they continue to trade very well. However, the situation here in the U.S. is a little more mixed, simply because, as we've said a couple of months ago, it is very difficult to see U.S. equity markets move higher until two things happen. The first thing that needs to happen is oil prices. They don't need to go back up to where they were late last year or even the beginning of this year, but they need to stabilize. So over the last week, we've seen a renewed drop in oil prices. Second thing that we need to see is a stable dollar. Now, again, we don't need to see the dollar return to levels that they were last year in order to see equity markets stabilize and move higher here in the U.S., but we do need to see the dollar stop appreciating so aggressively against the euro and to a lesser extent the yen. So in this past week, those two developments have reappeared on the scene, and the dollar has continue to improve, very, very strong and strengthened versus the euro, and and oil has continued to drop. So U.S. equity markets, unlike Japan and unlike euro, is a much different situation right now. My core view here for my clients and for investors is that the U.S. equity markets continue to be a good spot for longer-term investments compared to U.S. fixed income markets, which yields, after trading up to 225 on 10-year notes late last week, are back down to around 208, 209 today. So the combination of the dividend yield on equities with the earnings yield on equities still provide a much more handsome return than on U.S. bonds. The other asset class that I think should trade extremely well here is high grade and even high yield credit in the U.S. as interest rates stay low. The economic backdrop, as evidenced by decent employment figures late last week, should prove a good, stable background for corporate and high yield bonds to trade better. So the message again this week is, until the dollar and until oil price is stable, investors are best with sticking with U.S. markets, but you need to be patient on the equity side. Fixed income, I think investment grade and high yield is better than government bonds. In Europe and in Japan, tremendous price appreciation and potential for more price appreciation. However, the fact that those currencies are so weak obviously will offset any gains that you have in the equity markets. That's it for this week. Edward Talisse, Chelsea Global Advisors and the CQF Institute. Please check out the website at the CQF Institute and my own website at www.chelseaglobaladvisors.com. Thank you.